Hey everyone, thanks for joining me today. I'm going to be speaking about tax planning and should you have a Roth account or not. So we're streaming live on Facebook, on YouTube, and on Twitter through Periscope. So sorry, it was a couple second delay because Twitter was acting up in Periscope more specifically for that. But I'm excited to talk with you today about Roth accounts. Roth accounts are super awesome, super flexible accounts. The problem is they're not for everyone. They're not a perfect fit for every situation. And so we're going to talk about that a little bit more and find out how these things work and whether or not they make sense for your tax plan and your retirement planning, because Roth accounts are retirement accounts in case you weren't aware of that. So we'll dig into that a little bit deeper. My name is Lucas Caceres. I'm a certified financial planner, and I'm the founder of Level Up Financial Planning and Power Up Tax Planning Services. So I have a ton of fun working with my clients with Level Up Financial Planning, helping them plan for their future. And I ended up launching Power Up Tax Planning Services because I realized how valuable it is to just be able to help my clients all the way through with their tax planning and then actually implementing the taxes and filing the taxes for them. So still have fun with the tax planning, but my heart is really in the financial planning side of things. So I will have to show you my disclosures that are required. So since I'm a financial planner, I'm required to just kind of share with you, this is a workshop for educational purposes only. Do not feel like anything I say is very specific to your situation because I don't know your situation. I work with my clients directly, and when I give them recommendations, that is for their situation. But just kind of generally speaking here, it's going to be for education. There's probably going to be things that you're going to either have to go back and double watch this. It will be recorded. There could be things that you take notes and you have to go dive a little bit deeper. Always reach out to you if you think that I could add additional value on that front. So I shared this quote in my first workshop, and it's because taxes are important. For some people, taxes could make up about 30 to almost 40% of the income that you make. So the gross income, you pay state taxes, you pay property taxes, you pay federal taxes, you pay Social Security and Medicare, you pay sales taxes, if I didn't mention that already. So you just are getting taxed all over the place. And so that's why this is a favorite quote of mine revolving around taxes. And it was Benjamin Franklin who said, "In this world, nothing can be said to be certain except death and taxes," because it's almost guaranteed you're going to be taxed one way or another. And so we'll definitely dive into those complications with the retirement accounts. So more specifically, the topics we're going to be covering, it is going to be the what's a traditional retirement account. And basically, that's what most of us already know that we have. You might be somewhat familiar with that just because that's something that you have already through your traditional 401k. Maybe a long time ago, you opened up a traditional IRA. So that's the traditional side. They also have Roth versions of that. So that's important to be aware of. We'll talk about how those things compare to each other. And then we'll be diving into ways to fund a Roth. So there's a few different ways which are important to be aware of. And the perfect amount of Roth. So we'll dive into some of the details there as far as how you can estimate and calculate what's the perfect amount of Roth that you could want going into retirement and with your retirement planning. And then one of those clear situations where it's obvious that you should be funding a Roth or highly consider funding a Roth account. So first, we're going to start with the traditional side. So that's traditional IRA or traditional 401k. There's pros, which obviously means there's going to be some cons coming up next. But the pros are it reduces your income. So anything you contribute out of your own paycheck to these traditional IRAs or traditional 401ks, it's going to reduce your income, which reduces your taxes for this year. And so that's awesome that you have the power and flexibility to reduce your taxes if you want to. And another benefit of those retirement accounts is they're allowed to grow tax-free. So every single year, if they grow, you're not going to have to worry about paying taxes on those things just yet. However, on the con side, ultimately, when you do retire or if something came up and it was emergency and you had to withdraw funds, you are going to pay taxes at your ordinary income tax rates at that point in time. So you do get a lot of benefit and flexibility with being able to contribute and get some tax benefits there. It grows tax-free. But when you do take it out, you are going to be paying taxes on that. Another con potentially is just the restriction that normally you can't access these types of accounts until you're age 59 and a half. And so that doesn't matter if you leave your employer or not. You still can't take the money out without having to pay taxes and potentially the 10% penalty if it's withdrawn before age 59.5. There are some additional rules that you might be able to skate around there, but it's few and far between where people would qualify in that situation. I mentioned that just because you left your employer, you're not able to take the funds out. That's kind of out to your checking account, out to spend. You kind of roll it over to an IRA and be able to take it from your employer's 401k and put it into another retirement account. If you do that, you're able to avoid the penalties. You don't have to pay taxes. So that's called a rollover, just in case you need to dive into that. I know one of the big things that I have when I have clients is like, oh yeah, I've worked here, and here, and they have retirement accounts at 5 different places. Well, we got to hunt these things down. We want to consolidate them and keep them in one convenient location so you know at any given time what's going on and where all of your stuff is. So that was the traditional side. Let's focus on the Roth. Again, the Roth is a little bit more complex. There's a few more pros and a few more cons that we're going to have to navigate and weigh here. So cool thing, they grow tax-free. You'll never pay taxes on those funds again. There are some rules that I'll talk about on the con section here in a second, but those are the two biggest reasons why Roths are super beneficial, super awesome, that you can just say, yep, I put my money in a Roth, whatever that grows to, it's going to be tax-free. I'm never going to have to deal with the IRS or the federal government as far as trying to get their fingers into these Roth accounts. At least that's what it's supposed to be. So that's awesome. Kind of an additional fringe benefit for clients as you're getting older. Something that weighs heavily on their mind is beneficiaries. So beneficiaries are the people that you assign to your account who, if something happened to you, they're going to inherit these accounts. And Roth accounts, whether it's an Roth IRA or a Roth 401k, if it's in those Roth category, they'll receive those funds tax-free. They could just take it all out, not have to worry about taxes. So that's a huge difference between the tax bomb that could potentially be a traditional 401k or traditional IRA that's inherited. If someone takes all that money out, they won't receive penalty because you pass away. That's one of the ways that they're able to avoid that penalty, but they will have to pay taxes on that at their ordinary income. So if they withdraw from a traditional 401k or traditional IRA, that's going to all land on top of their ordinary income they earn through their normal job anyway. So that's a huge benefit for Roth IRAs and Roth 401ks is your beneficiaries can take those funds if something happened to you and they inherited it and not have to worry about any penalties or situations there. One awesome thing too that a lot of people are not aware of are the contributions you make to a Roth account. You can actually go and take those back out without penalty. So we mentioned the penalty on the traditional contributions that you make. You do not have to worry about that with the contributions to a Roth account or a Roth 401k. You do want to track these things. Sometimes your employer retirement accounts, sometimes your Roth IRA accounts don't track that for you all that well. So you'll want to keep track, make sure you know if that's going to be a need. I know this is the case because I had to hunt down that information myself. When I launched Level Up Financial Planning, I dipped into my Roth contributions a little bit. Didn't have to worry about any penalties there because I only removed the contributions. So again, since there's pros, we know there's cons coming up. Since you get all these awesome benefits and retirement features for the Roth, we know that there's probably going to be some rules we have to play by. So one big thing that you'll notice compared to the traditional side is those contributions you make to your Roth IRA and the Roth 401k, that is not going to reduce your income. It's not going to reduce your taxes. So that's a big decision. That's a big decision point and a big factor when you're trying to decide, should I do traditional? Should I do Roth for these types of retirement accounts? That retirement age is still 59.5, but that is only relevant to the growth on those accounts. So for the Roth IRA, Roth 401k, that retirement age restriction and that 10% penalty, that's only on the growth above your contributions because, again, you can take your contributions back out. And I mentioned that the taxes, right? So with traditional, you get to reduce your taxes, and with Roth, you don't. So that's a big factor when you're trying to decide, well, should I do a traditional or should I do a Roth contributions? And really what it comes down to is, well, how comfortable are you in paying taxes? This is the single filers. I'll jump to the joint filers and you can kind of see how those things compare. But basically what I do with my clients is I target with them, hey, what's the upper maximum that you'd want to be paying on your taxes before it just gets too painful? And at some point, that tends to be the case. Right now, for most of my clients, it's usually around 32%. They're like, yeah, if I make that jump from 24% to 32%, where almost a third of my income at that point is going to be taxed for federal taxes. I'm never going to see that money again. Then that's usually a threshold where, yeah, if we're in the 32% tax bracket, we might not be making Roth contributions normally. There's some cool behind the scenes things you can do. I'm not going to dive into it too much, but I will give you a hint at what that is in case you need to dig in and do some additional research. But yeah, taxes now is a huge factor in deciding, well, should I do traditional or should I do Roth? And then also taxes in the future. And we'll dive into that in a little bit. So there are limits to these things. So we'll talk about the traditional limits first, and specifically the IRA. So the IRA account, you'll notice, is significantly less in contributions that you can make. So you can only do $6,000 in contributions per year to an IRA account. If you happen to be 50 or older, you have to do an additional $1,000. If you kind of look over to the 401k section, that number is a lot bigger, right? So 19,500, and then an additional 6,000 if you're 50 or older. That's a big difference, and people don't realize that for some reason, if you just happen to have an employer that offers a 401k, you get to have a lot more flexibility in controlling your taxes. I don't think that makes sense, but someone figured it did for some reason, and that's why things are so lopsided. Additionally, if you do have an IRA, but you have access to a 401k, you're limited as far as making deductible contributions. So that means if you make contributions to an IRA account and you exceed these thresholds, if you have a 401k, which is for a single person, 65,000 to 75,000, it starts to phase through there. And after 75,000, you just don't get to deduct any of it for your taxes, which makes this kind of a pain in the butt. There's some backdoor things we can do that I'll hint at in a second. Then that income limit is a little bit higher for joint filers. So if you happen to have a 401k and married filing jointly, that phase out begins at 104,000 and then totally phases out 124,000. If only your spouse has a 401k, that income limit at least increases pretty significantly at that point. But still, it's kind of a pain in the butt to have these restrictions, especially if your 401k just is not great with your employer. I know a couple of my clients that work for kind of earlier startups, smaller tech companies, and basically the company's pouring all the money into hiring people and reinvesting and just trying to grow a product and put something out there that's going to be awesome. They're not necessarily always trying to give you the best benefits. And so sometimes you don't get a good 401k, you don't get employer matching, or the investment options are horrible or really expensive. So that's important to be aware of. That the cool thing about the 401k is if you have that, if it's actually a good plan, you can throw a lot of money in there for traditional and reduce your taxes pretty significantly. And there's no income phase outs for that. So you can throw a lot of money in there. There's no limit to how much income you're making where that would be phased out. So things get a little bit more different and complicated for ways to fund a Roth. So you'll see in here, there's an additional kind of line item, and sorry I didn't stick with the same format that I've done, but I love this cheat sheet I made last year, and this is ways to fund a Roth. So you can do a Roth conversion. So that's something that isn't something that you factor in on the IRA side. So what happens with a Roth conversion is you decide, you know what, for whatever reason, you might feel like it's a good tax year or just a good time to do it. You're going to take funds from the traditional side and move it over to the Roth side. In doing so, you are going to pay taxes at that point in time. And then once it's moved into the Roth account, you're never going to have to pay taxes on those funds again. So there is some reasons to do that. And that's just a unique aspect of Roth accounts, is a unique way of funding those. There's no limit as far as income. There's no limits as far as how much money you can do that to. So up to the maximum you have in your IRA or 401k, it's basically that limit. It's kind of up to you and up to your account size. For this one, it is important to be aware of that there is a 5-year limit to avoid penalty on the converted amount. So it's not like your normal contributions you make to a Roth where you can easily take those out. If you did a Roth conversion, those funds do have to stay there for 5 years in order to avoid the 10% penalty. So that's something to be very aware of, because it's different than the rest of the Roth contributions and the rest of the ways you can fund a Roth account. So the Roth IRA, anyone with earned income can basically access a Roth IRA. You can go to your bank, you can go to Fidelity, you can go so many different places and open up a Roth account. The biggest issue is there is going to be income phase outs, and you see those below the funding limits, very much the same as the traditional IRA side, where 6,000 is the maximum. And then if you happen to be 50 or above, you have to do an additional 1,000. You have to have earned income to do this. And contributions can be removed without penalty. So that's one of the awesome things about these Roth accounts. With the Roth 401k, the biggest pain in the butt here is not all employers offer Roth 401ks. I was just trying to help one of my clients do this the other day and change contributions to Roth contributions, and they didn't have the option. So that's a pain in the butt. So not all employers have it. You might be like, oh, Roth sounds amazing. I'm going to go into my 401k. I'm going to start contributing there, if that makes sense to you. And you might find that you don't have a Roth option there. What you can do is ask your employer and maybe talk to a few people and tell them to ask your employer, because it's really easy. I've worked with organizations and companies that we put a 401k in place, and I was like, oh, what does it look like to add a Roth for these clients and these businesses? They're like, oh, you just check off a box and it doesn't really change the cost. It doesn't change anything. I was like, oh, that sounds easy. So it doesn't really make sense to me why not all 401ks offer that option. There's not going to be any income phase outs, but there is the same funding limits that you'd have with the traditional 401k. So still 19,500. Again, comparing that to the Roth IRA contribution of 6,000, dramatically more. Doesn't necessarily make sense to me. It feels like people who work for smaller employers that don't offer 401ks kind of get penalized there, even if they're making enough income and want to throw more at these accounts. You're just limited significantly more on the Roth IRA side compared to the Roth 401k. And that's why it is nice if you do need to ask your employer, like, hey, we only have a traditional 401k, but I really want the Roth. Just ask for it in the next year. You might be able to get that added on pretty quickly. And so the cool thing here is for the Roth 401k, you might not be able to withdraw the funds directly from the 401k until you leave employment. But if you do leave your employer, you move those funds into a Roth IRA, then you get to access those contributions, just the same as if you made those contributions directly into the Roth IRA. So there is an additional way that you can fund Roth accounts. It's too complex to even try to throw in a workshop where I'm trying to cover so much other ground. But basically, there's things called a backdoor Roth conversion, that if you have a lot of income, if you are in this phase out for the Roth and are unable to contribute due to your income levels, I would look into backdoor Roth conversion and reach out if you have questions. I'd be happy to kind of talk you through what to expect with that. So which one's better? We've been talking a lot about traditional, a lot about Roth. I know it's sometimes hard to put a grasp on these things if it's the first time you're hearing it for the first time. Again, feel free. This video is going to be recorded. You can go back and kind of rerun through it, and then also just look up additional things online. So Roth versus traditional, which one's better? Well, it does depend. So I mentioned that your tax rates now is a huge factor, but also the tax rates in the future. So if you expect the taxes and your taxes specifically to be lower in the future, then a traditional might actually be a great way, because as your funds come out, even though you're going to be paying taxes at that time on those withdrawals, you're expecting to be in a lower tax bracket. So it's not going to be as bad of a situation. So that's not too bad at all. On the opposite end is if you expect that your tax rates to be even higher than they are now, then that makes a Roth the clear winner, because as you're making withdrawals out of your traditional retirement accounts, you're going to be paying higher in taxes than you are today in making those deferments. Then it makes sense to do Roth contributions today and have some Roth account in the future to be able to withdraw and kind of balance those things out. So kind of mentioned balance. There's the perfect amount of Roth. There's no clear answer because everyone's different. Sometimes everyone's starting at different ages, everyone's starting with different balances, different incomes, different filing status, married, filing jointly, single. So there's so much complexity. It's hard to say, hey, this is the clear percentage or dollar amount that you need in Roth compared to traditional. One thing I would say with confidence is you do want both. You don't want to be all on one side because you don't have any balance. You don't get any flexibility there. And it's going to depend on your cash flow. It's going to depend on your tax rates now and then the future tax rates. And then also a huge factor is the time between you making these contributions and how much time those have to grow tax-free. So when you make these contributions to the Roth and they grow tax-free, they get withdrawn tax-free. But if you make these contributions to a traditional side, they'll grow tax-free, sure, but that's all going to be taxed at some point in the future. So that's a huge part of the equation when you're evaluating these things. This is just an example of the wealth management tool I use. This is an example of one of my clients where basically if we're going to do Roth conversions for him, which basically means we're going to move those traditional IRA to a Roth IRA and pay the taxes now. And basically what I factored in, it's hard to see here because it's not a significant amount, but he has not filled up the 22 to 25% tax bracket. So what I did with this Roth conversion evaluation tool is I said, well, there's some additional income that we can increase and recognize and pay taxes on it now. And it would be better for you in the long fall. And you can see it's almost an $8 million difference, which is crazy to think about. But when you look at the age, he's only approaching 30. So that's because of all the years of growth. And that's going to make a big difference. So basically he does small Roth conversions every single year to fill up to that tax bracket. And he's moving it all along that time period into Roth accounts that are never going to be taxed again. So you see the huge gap in where there's just no green line. That means he's not paying any income taxes those years. He's able to live off of non-retirement funds, Roth funds, and things like that. And then what happens is there's something called required minimum distribution. So if he did have a significant amount of traditional IRA balances or traditional 401k balances at that time, he's going to be forced to take withdrawals and forced to pay taxes at that time. But in this situation, the green is how much income and taxes he would have been paying, and the blue is kind of highlighted underneath. And then you can see it's a huge savings. This huge gap here is all the income that he's paying taxes on if we don't do Roth conversion. So it's pretty ridiculous, the impact of being strategic and just doing these things now. And it's not a significant amount of Roth conversions. You can barely see that blue line, but they add up over time significantly. So one thing I just wanted to show you is how it theoretically would look if someone was retired today. The maximum amount of Social Security that you receive is about $45,000 a year for 2020. So I kind of use that as their base income. I put that they're going to make $150,000 in traditional retirement accounts, which means it's all taxable. No Roth distributions that live off of no income from the Roth account. In this example, I'll show you the opposite end if they did have some Roth that they're able to pull a little bit of both. But basically the taxable income comes to $176,258. You might be looking at these numbers and be like, hey, that math does not work. That should be like $195,000. What happens is Social Security, not all of Social Security is taxed right now. When your income goes up, it kind of phases up how much Social Security or how much of Social Security will be taxed. And basically, once you get to the highest range, 85% of that $45,000 is counted as taxable income. So that's why that taxable income number looks a little bit lower than you'd expect. Once you kind of factor in all the different tax brackets and find the effective tax rate, basically this person's going to pay $37,417 in taxes that year. And what it means is they're in the 32% marginal rate. And I covered this in the understanding your taxes. So if you do need to go back and kind of figure out, well, what the heck is he talking about? Marginal rate, effective tax rate. You can go back, and I spend a little bit more time going into detail on here. Basically, we're in the US, we're a progressive tax system. So you don't pay a flat tax of whatever bracket you fall into, which in this case, it's that 32% tax bracket, and pay 32% on all your income. You actually get your standard deduction. Then you start paying 10%, 12%, 22%, 24%, so on and so forth until you kind of reach your taxable income. In this situation, this is how much per tax bracket that you're paying in taxes. And the total comes to that $37,000 value that we talked about. So that's with no Roth contributions there. So if we look at a partial Roth example, this is where it's pretty interesting because you actually don't need to make as much of a withdrawal. So if you remember, between the IRA account and the Roth account, we weren't taking anything in the previous example. Still, it was $150,000 that was a distribution. Because you don't have to pay taxes on the Roth portion, you actually can withdraw less. So it's about $13,000 less that they're going to be removing from their retirement accounts because they don't have to worry about that additional taxes. Basically, they still get to live the same type of life, and they just pay less taxes, and a portion of that is not going to be taxable. So the taxable income number is super low there. The total tax liability is $24,380. So the marginal rate, which is the rate that they fall at for their newest income, if they were to add additional income on top of this, they'll be paying that 24% until they move over to the next bracket. And then the effective tax rate is basically all of their income being divided by all of their taxes. So, or the other way around, their total tax liability divided by all of their income. So effectively, they're only going to pay 13% in taxes on the income that they're withdrawing. This just, again, shows you those numbers and kind of how they stack up. They avoided the 32% tax bracket in this situation. And so that's why they're in the marginal bracket of 24%. Significantly less income taxes being paid on that, with just a portion, almost a third, coming from Roth accounts. So you don't need a significant amount to be in a Roth in order to make a difference. This is just lining up all that same information side by side so you can kind of see what the heck happened there. They're basically moved their withdrawal from the IRA, a portion of that, to the Roth. Didn't even have to pull out as much because it's not being taxed as heavily. You still end up with the same money at the end of the day, but just pay significantly less in taxes. And so you might be looking or just listening to this and wondering, well, why don't people just put everything in Roth accounts? That is a horrible mistake. That's one thing that a lot of people do. People hear that, oh, Roths are so awesome, you'll never have to pay taxes on this again. And they are awesome for that reason. But it's a huge mistake. I've seen it so many times that older people just start going crazy doing Roth conversions, paying a lot of taxes, pushing up their tax brackets in the 32, 34, and just it's super painful for them, but they think it's the right thing to do. And it's not. It's a big mistake to be all in Roth because you lose out on the free standard deduction. So especially if you're married filing jointly, that's $24,800. So that's a lot of income that they could move from an IRA account, $24,800 from an IRA account, not even be taxed. So that's a huge loss if you don't even have IRA accounts because you moved everything to a Roth. So you're giving up on that tax efficiency. And the first few tax brackets you saw, right now they're pretty wide. It's not that bad paying 10% or 12% if you're a high income earner, if you're in a higher tax bracket. So there's a lot of things you can do that will be a lot more efficient and just fill up these lower tax brackets and have some Roth and some traditional. Don't ever go to all Roth. That it's just not smart. So a reason to why you do want some Roth is they do provide a lot of flexibility. So you might be like, I don't even know what taxes are going to look like in the future. Well, yeah, no one knows. So that's why it's good to have some there because you're kind of hedging your bet. You don't have to be all in one way or another. Just having some there is going to give you a lot of flexibility to navigate different changes in tax laws. Will help smooth out things. So every now and then when people retire, they're like, oh, I don't want to have another auto loan, but I need a new car. Let's just take $30,000 or $20,000 out to purchase a new vehicle. Well, if all you have is traditional retirement accounts, that's an additional $20,000 or $30,000 of income that maybe you're not used to taking every single year. That's going to bump you up to another tax bracket potentially. So large withdrawals, that's something that are super painful. And so it's helpful when you do have a little bit of Roth to smooth out the edges, make sure you don't accidentally bump yourself into a higher tax bracket. If you want to retire early, there's health insurance premiums that you can actually fit into the subsidy windows and not have to pay $1,000 a month or $1,500 a month for health insurance if you retire before 65. And that's a huge savings if you're able to keep your income down, your taxable income down. The problem is if you retire early and all you have is traditional IRA money, that's all going to be taxable income. That's going to jack up your taxable income and it's going to boot you out of that window where you're able to avoid these super high health insurance premiums if you retire early. So that's a big one as people are approaching retirement that they don't realize, like, oh, yeah, you might want to retire 5 years and you might have a lot of money to do so. It's going to be a lot more expensive than you were thinking because you're used to paying $200 a month for your health insurance. Well, now it's going to be $1,500 and your deductible is going to be ridiculous on top of that. So there's a lot of benefits of having Roth to avoid these things. You could save thousands and thousands of dollars just after a couple years of early retirement and reducing your health insurance premiums. Navigating credit phase outs. So one of the things I talked about in the Understanding Your Taxes is there's various credits that you might be eligible for. More specifically this year for the Secure Act that came out, or this one was the CARES Act for COVID. Basically, some people were able to receive these credits, the free money, stimulus checks from the government. And that was only if your income was within a certain range and threshold. So that's a perfect example is if you use some Roth and some traditional, you could keep your income under some of these thresholds and phase outs and be able to have a better tax efficiency and be able to take advantage of different tax futures and credits that might be available to you. Then I already mentioned it a little bit earlier, but Social Security, you do pay taxes on that. So sometimes if you're able to, you might be able to stay above or stay below that 85% of your Social Security being taxed. And so it might be 50%, or you might even be able to make it towards 0%, depending on how much Roth you have and how much funds you need to kind of live. It would be hard, I'd say, but you can definitely avoid the 85% of your Social Security being included in your taxable income. And that could save thousands of dollars too. So when should you contribute? Again, it's not always clear, cut and dry, like, oh, you should do it every year or you should have X amount. But there are a few times when it is clear, and that's early in your career when your tax bracket's probably lower, even in the first 2 to 3 years. If you're just starting your career, usually there's going to be a huge ramp up for you where your tax brackets might jump significantly 2 to 3 years out, and then especially 5 or 10 years into your career. So you want to take advantage of your time. Technically, your expenses are a lot lower usually when you're starting your career. So if you're able to save more now, save into Roth and allow time to work for you and allow these lower income tax brackets, pay taxes now, put it into the Roth and let that grow, that's going to be a huge benefit to you. If you have a career transition, I work with a lot of boot camp clients where basically they take a year off to transition careers. And so their income goes to almost zero or zero. And so if you have old retirement accounts, you can do some Roth conversions, super tax efficient. You can pinpoint how much you want to pay in taxes, and that's a great opportunity. This year with COVID, a lot of unemployment. So if your income has dropped significantly, there might be some benefits to do Roth conversions and control that before the end of the year while your income is lower and your income tax brackets are lower. I have a couple clients that have some fun sabbaticals that they're planning 3 to 4 years out. And so their income's going to be almost zero for a full year. Well, we can do some Roth conversions there and pay like 10% rather than their normal income tax bracket. So there's a lot of clear-cut times where you should definitely consider Roth contributions or Roth conversions. And then again, I mentioned and hinted at it a couple times. I'm not going to go into the complexity of a backdoor Roth contribution, but it is something you can do if you have significant cash flow and are phased out of the normal kind of Roth contribution windows. So those are clear-cut ways. There's a lot of ways you can control your taxes. I've estimated and built out a strategy guide where there's like 15 different ways you could potentially do it. Still, even at this point in the year, we're in October 2020, you can do a lot of things to reduce your taxes. There might be some things that you can offset and make a tax situation be either tax neutral or just offset some of the taxes of your stock options. There's some tax efficiency you can do. So if you have stocks that unfortunately were hit a little bit harder this year than some of the other ones, and you have losses, you can use that from a tax efficiency standpoint to reduce your taxes this year. And there's a few other ones. Basically, the one that we covered today is paying taxes now and avoiding taxes in the future. That's what the Roth contribution is. That's what Roth conversions do. So we covered that portion pretty heavily in this particular presentation. This just kind of shows you even though there's 15 ways, these are the main kind of areas where you can still control your taxes for the rest of 2020. So you can still change what you're doing with retirement contributions. You can make health savings account contributions if you're eligible for an HSA account, health savings account. And if you have employer stock, there's a lot of stuff you can potentially do before the end of the year. There's charitable gifting. That is going to be the next presentation. So stay tuned for that. There's a lot of tax efficiencies and things you may not be aware of due to some of the tax changes and tax law changes that occurred about 3 years ago now. So we'll dive into that more specifically next time. Then I'll also be talking about, actually, I have the whole list here. Taxes and retirement would be the next one. And then the final one, obviously we have an election coming up pretty soon here. Get out and vote. That's super important. But we'll talk that Thursday following the election on what's the impact on your taxes. What are things that might be coming down the pipe that we need to be aware of, and be strategic and efficient about your tax situation. So hopefully that was all helpful, informational. I provide a lot of free content. It's not just these workshops that I manage to muster up every now and then, but I have other videos. I have a podcast. I have strategy guides, cheat sheets, and things like that. Most of those would be found on my Level Up Financial Planning website. I also do tax planning. So if you're thinking about your taxes and you're like, oh, I hate doing TurboTax, or you're not really a fan of the person that does your taxes, I do have a limited number of spots available. Tax planning is not the exciting part of what I do, but it is something I do to help people and then make sure that they're understanding and confident in what they're doing on their taxes. So if that's something, I do have a free spots available for 2021. Reach out, because it is first come, first serve there, and I do limit that. There's my email address if you just want to get connected directly. But I have too much fun talking about taxes sometimes, but it's because it has such a big impact on the value I'm able to provide my clients. That's why I push myself to stay up to date and stay relevant on all the different strategies and different ways we can maneuver stuff around and kind of fit the puzzle to make sure that it's benefiting you the most. Obviously, taxes are good for roads. They're good for different government projects and entities. But at the end of the day, you never want to pay more taxes than you need to. So hopefully these workshops have been helpful for you, and there's going to be more to come. Make sure you sign up to stay up to date and be notified of the next live events. And right now, they'll be live every day or every Thursday at 5 p.m. For the next few Thursdays until after the election. So thanks for joining me. If you have any questions too after kind of watching that, I'm able to stick around for a couple minutes and make sure if there's any big questions, things I can identify, I can definitely do that as well.